Hey America, welcome back to the channel where we cut through the noise and look at the global economy with a Wall Street lens. Today we're crossing the Atlantic to Madrid, because what's happening in Spain right now should set off every alarm bell in Washington, New York, and every US exporter doing business in Europe. Spain used to be the comeback kid after the 2008 crash and COVID. But under Prime Minister Pedro Sánchez, the socialist playbook is in full swing, and the data shows the engine is starting to sputter. Let's break it down, number by number, policy by policy, and ask the question, is Spain headed for stagnation in 2025 and beyond? First, the headline numbers look good, on paper. Spain's GDP grew 3.2% in 2024, projected 2.5% this year. That beats the eurozone average of 1.4% and keeps pace with our own 2.5% forecast. Unemployment's down to 10.3%, the lowest since 2008. Tourism's roaring, 92 million visitors last year. Construction's back. Sounds like a European miracle, right? Wrong. Dig 1 inch deeper and you see a house of cards built on borrowed money, political chaos, and reversed reforms. Let's start with the debt. Spain's public debt is 101.8% of GDP, higher than pre-pandemic levels. That's $1.6 trillion in today's dollars. Compare that to the US at 122%, sure, but we're the world's reserve currency. Spain isn't. Every euro they print to pay pensions or green subsidies is a euro they can invest in factories, ports, or 5G networks. The Bank of Spain itself warned in October 2024, temporary tax hikes on banks and energy firms are counterproductive and reduce long-term growth. Translation: Sanchez is taxing the golden goose to pay for political survival. And survival is the key word. Sanchez runs a minority government, 152 seats out of 350 in Congress. To stay in power, he's cut deals with Catalan separatists, Basque nationalists, and far-left radicals. Result? No national budget approved since 2023. 3 years running on emergency decrees. Imagine if President Biden couldn't pass a federal budget because he needed votes from ANC and the Texas Secession Caucus. That's Spain right now. Investors hate uncertainty. Foreign direct investment dropped 12% in 2024, per Spain's own Commerce Ministry. US companies like Ford, Amazon, and Cisco are pumping the brakes on new plants in Valencia and Barcelona. Now let's talk labor, the one reform that actually worked. In 2012, Conservative Prime Minister Rajoy passed a labor market overhaul that slashed firing costs and let companies negotiate wages plant by plant. Unemployment fell from 26% to 13% in 6 years. Sanchez came in 2018 and started unwinding it. He banned most temporary contracts, mandated across-the-board wage hikes, and gave unions veto power over layoffs. The minimum wage jumped 22% in 2019 alone, then another 8% in 2021. Sounds noble, until you see youth unemployment still stuck above 25%. That's 1 in 4 Spaniards under 25 with no job. In the US, we'd call that a national emergency, but the real killer is the spending spree. Sanchez has burned through 55 billion euros in EU recovery funds, mostly on green transition and public sector payrolls. Pension spending is up 9% a year, even though Spain's population is aging faster than ours. Subsidies for electricity bills? 12 billion euros in 2024 alone. Where's the money coming from? New taxes on banks, energy companies, and anyone making over 300,000 euros. The IMF says these solidarity taxes shave 0.3% off GDP growth every year they stay in place. That's $4.5 billion lost, enough to build 3 new container ports in Valencia. And ports matter, because Spain is a top 10 trading partner for the United States. We send them $20 billion in goods every year, soybeans from Iowa, LNG from Louisiana, Boeing parts from Seattle. They send us $18 billion back, seat cars from Barcelona, olive oil from Andalusia, wind turbine blades from Galicia. But guess what? Trump's new 10% global tariff hits Spanish exports hard. A 2025 Rabobank study says Spain could lose 1.2% of GDP from US tariffs alone. Sanchez's response? More EU solidarity speeches. No trade deals, no deregulation, no Plan B. Let's put this in American terms. Imagine California running 9% budget deficits every year, raising corporate taxes to 15%, and needing votes from a San Francisco separatist party to pass anything. That's Spain. The OECD now projects Spanish growth will slow to 1.8% in 2026, below the eurozone average for the first time in a decade. That's the textbook definition of stagnation. So what's propping up the numbers today? 3 things, all temporary. 1. Tourism. Americans spent $22 billion in Spain last year. Thank you. Weak euro. 2. EU cash. The recovery fund ends in 2026. 3. Low interest rates, until the ECB hikes again. When the music stops, Spain is left holding the bag. Look at the bond market. Spanish 10-year yields are 3.3%, higher than Italy's for the first time since 2008. Investors are pricing in risk. Credit default swaps on Spanish debt are up 40% since January. Wall Street sees the cliff coming. Now let's talk politics, because in Spain, everything is politics. Sanchez survived 2 no-confidence votes in 2024. His coalition partner, Yolanda Díaz, wants a 32-hour workweek with no pay cut. That's a 20% productivity hit overnight. The Catalan amnesty law, passed to keep separatists on board, lets politicians who tried to break up Spain walk free. Rule of law? Optional. Moody's downgraded Spain's outlook to negative in September, citing political fragmentation. Compare that to the US. We argue over 2% tariff tweaks. Spain argues over whether the country should stay together. No wonder startups are fleeing to Lisbon or Austin. Spain's unicorn count, 12. Portugal, 11. Texas, 120. Here's the scariest chart you'll see today. Spain's potential growth rate, the speed it can grow without inflation, has fallen from 2.5% pre-Sanchez to 1.4% today, per the European Commission. That's structural damage. You don't fix that with more subsidies. You fix it with labor flexibility, tax cuts, and political stability. Sanchez is doing the opposite. So what does this mean for America? 3 things. First, a weaker Spain means weaker NATO. Madrid spends 1.3% of GDP on defense, half the alliance target. Second, supply chain risk. If Spanish factories slow, your Ford Focus or John Deere tractor gets more expensive. Third, precedent. If Sanchez's model works short term, Democrats will point to Spain as proof big government delivers. Don't let them. The bill always comes due. Let's wrap this up with a prediction. If Sanchez wins another term, or even limps through 2025 without reform, Spain enters a lost decade by 2027. Growth below 1.5%, debt above 110%, unemployment back to 14%. The EU will bail them out, but at what cost to the euro? And to US exporters stuck in the crossfire? America, this isn't just Europe's problem. It's our problem. Spain is the canary in the coal mine for what happens when you trade structural reform for political handouts. Watch Madrid closely, because the policies failing there are the same ones being pitched in Washington. That's the show. If you found this breakdown useful, smash that like button, drop a comment. Do you think Spain can avoid stagnation, or is the damage already done? Subscribe for weekly global market intel with a red, white, and blue filter. Until then, stay sharp, stay free, and keep your money moving. This is Personal Economics, signing off.